Congratulations, you've officially made it to retirement. But now you have to figure out how are you going to pay yourself in retirement. Well, stick around in today's video and Carlo and I can tell you some tax efficient strategies for yourself. In today's video with Ask Team FG, Carlo and I are going to be walking through tax-efficient income planning strategies for those of you who have officially retired. We've done a couple videos in the past about what you should think about in leading up to retirement, how you should save in those last 10 years or so, and now we're going to start thinking about, now we've officially retired, how are we going to start taking money out of the portfolio? So, Carlo, why don't you get us started?
Thanks, John. Yes, congratulations, you've retired. You're no longer working for your income, your portfolio is working for your income. But now how do we draw it out? That's the easy part for us. We'll determine how to do that on your behalf. We just want to make sure you have an income stream from your portfolio. And we will determine how to make that more tax efficient. The only thing that you should be concerned about is that you're getting $3,000, $4,000, $5,000 a month from that portfolio. In most cases, a retiree will likely have three types of investment accounts in order to draw from for their retirement cash flow. So that's a RSP or a RIF, tax-free savings account, and a non-registered account. And typically what we want to do is pay you the least amount of taxable income for your cash flow. But that's not to say that your taxable income won't be made tax efficient. But that's something we can be doing behind the scenes after you've received your monthly or bi-weekly cash flow from the portfolio.
So if we start thinking about the different types of accounts, each one of them is going to be taxed a little bit differently. So start thinking about if you have a pension. If you have a pension from your employer, also considered Canada pension, it's all going to be taxed as income. So whatever you have coming in is going to be showing up on your tax return as that's the amount of income that's going to be considered taxable. The registered retirement savings plan is going to be very similar. So the registered retirement savings plan, whatever gets drawn out of that, again, is going to be added to your taxable income. Where we're going to have a couple different accounts that are going to be more favorable for you is going to be the tax-free savings account, which, like the name implies, entirely tax-free, and then the open account or non-registered account. And that just, you have to pay capital gains, dividend, even interest income to come out of that account. Now, balancing these three types of accounts is going to be the most important thing for us to ensure that you're getting the most on a monthly basis with the least amount of tax. Like that would be ideal. However, we don't want to kick the can down the road and not take money out of the RSP or the RIF until it goes to the estate, and then there's taxes that'll have to be owing there, right? So there has to be a balance between those three.
Yeah, John, those are great points to make. And what people have to realize is different forms of investment income is taxed differently. And so we talked about it already, capital gains. You only have to add, at this point, 50% of your capital gains as taxable income. That's going to change after June 25th, but that's for a separate video. Dividends are taxed a little more favorably than interest income because you are or could be eligible for a dividend tax credit, which pays a portion of that taxes ahead of time from the credit. And lastly, any interest income that you earn is 100% taxable. Knowing that, our goal is to try to minimize your tax bill by manipulating your portfolio so that your annual tax bill from your investment income is small. So when we think about dividends and capital gains, they're taxed most favorably. We want that type of investment income in your non-registered account, which is a taxable account. The types of investments that would pay interest income, which is taxed more heavily, you have to add 100% of it in, we want that under the tax shelter, whether it's your RSP or your RIF. That's what we'll be looking after while still paying you your monthly or biweekly cash flow.
Yeah, and if this is a safe space, I want to say one of my pet peeves that I've had, and it happens frequently with our clients that are into retirement, because they naturally start thinking we need to be a little bit more conservative. And for some people, that might mean GICs or high interest savings accounts. But now you're accruing significant amounts of interest income that may even take away from other government benefits. We've had some clients that are accruing interest to the point where it's now clawing back their old age security or paying additional tax, so you're losing your government benefits. Just like you said, Carlo, it's not like we don't want you to not have some sort of security and some degree of bonds or GICs. Put them in the correct accounts. If you're accruing that degree of income, that just means your tax bill's higher and you get to lose out on some other benefits as well that come from the government. So there are smarter ways to go about it. You don't need to be ultra conservative and only receive interest as a rate of return, even though interest rates are high. We do know that. But at the same time, you need to be smart about how that income's coming in and not really focus on the rate of return per se, but we always focus on the after-tax rate of return. That's the most important thing, because we know taxes are going to be there regardless. If we can pay as little tax as possible while still getting the highest return possible, that's what we'll do.
John, we've gone a little deep into the woods when it comes to the details of why we invest the way we do or why we manipulate the investments around different accounts. That's something that we can discuss in your meetings when you come in. If you're watching this video and are not a client and you have questions about it, please feel free to contact us, have a conversation about your current retirement cash flow. Is it tax efficient? Are you doing the right things to try to minimize your annual tax bill? We're more than happy to have that conversation. Again, what do we take away from this video? Cash flow is important. Tax efficient cash flow is what we should be striving for. At our office, we're focusing on retirement planning, making your retirement the best it can be. We have many different videos about retirement planning. Watch any of them that pertain to you, or again, contact us if you have any questions. Again, if you do like our content, please do subscribe to our YouTube channel, give us a like, or provide us with a comment. Until next time, I'm Carlo Cancino.
I'm John Iaconetti.
And this has been Ask TMFG.